Welcome to the weekly update, where I'll go over the action in the market for February 27th through March 3rd, and then we'll see how things look for the week of March 6th through the 10th. We had an up week. The market could have gone down a lot more than it did. Later in the week, especially on Thursday and Friday, we saw a pretty nice rebound. A little bit of a rebound on Thursday and then a pretty strong day on Friday. So let's go back and talk about what happened. To give you an overview of what happened in the week, the market was able to break its losing streak despite ongoing inflation concerns and the fact that rates are rising. The market was getting to an oversold condition, and if you watch the daily videos that I put out, I kept harping on that over and over, especially on a short-term basis, and then it bounced from that level. The ISM Manufacturing Index, which came out, the weekly jobless claims, and the revised fourth quarter productivity, it did not help to slow down these inflation fears. And the 10-year note, which got above 4% and went all the way up to 4.07% before pulling back down to 3.96 by the time the week ended. The dollar also fell for the week down to 105.40. With interest rates going up and then coming back down, that gave support to stocks. And then the dollar pulling back also gave some support to stocks. Oil, which has been right around $80 a barrel, fell just below that at $79.79. So just to recap what happened, on Monday we had this early positive momentum, and that gave way to prices then declining, with the S&P going below its 50-day moving average, which at that point was at 39.80. On Tuesday, the market was mixed and didn't really have a lot of conviction. We were just chopping sideways. But the S&P did regain its 50-day moving average at 39.79, but then going into the close, it fell back below that level. On Wednesday, the S&P fell, but it was able to find support at its 200-day moving average at 39.40. This is when we've started to get some Fed speak. Minneapolis Fed President Kashkari, who is a voter right now, said that he's leaning towards raising rates further. The market didn't really like that. Then also Atlanta Fed President Bostic, and they're calling Thursday and Friday's bounce the Bostic bounce, who will be a voter in 2024, said that he thinks that the Fed should get to the 5 to 5.25 range and then hold it there well into 2024. Then on Thursday, the 10-year note went all the way up to 4.07%. After the Eurozone reported a very strong core CPI that was 5.6% on a year-over-year basis. The S&P ended up falling below its 200-day moving average at 39.40, but then bounced later in the day. The S&P closed just under its 50-day moving average on Thursday at 39.83. Atlanta Fed President Bostic came out again and said that he favors a 25 basis point rate hike. The market liked that because there's been a lot of talk at a 50 basis point hike. So what he said was seen as dovish. He's the one that said on Wednesday that the Fed needs to go to 5 to 5.25 and then leave it there well into 2024. Then on Friday, the S&P opened above its 50-day moving average at 39.87 and kept climbing throughout the day. The 10-year note ended up coming back under 4%, as I mentioned earlier, and that gave some good support to stocks. So for the week, the S&P was up 1.9% on below average volume, and that's a little bit of a concern. I've been really harping on this in the daily videos, where if we have an up or a down day, we're still having below average volume, which suggests a real lack of conviction. The technicals are still positive overall, and they're showing some improvement, and I'll go through the charts to show you that. Because of this inflation and interest rate scenario that the markets are just totally fixated on, our trend is weakening. We're under 20 with the ADX on the weekly chart. We're also under 20 on the daily chart, but the green line on the weekly chart is slightly above the red line, so it's just barely positive. Here's the intraday chart. Going back to Monday, we had a gap higher from the previous Friday's close, but then we just drifted as the day went on. On Tuesday, we didn't really have a lot of conviction. We tried to go back up and then ended up coming down and closing at the low. On Wednesday, this is when we came down to the 200-day simple moving average, and that provided some pretty decent support. It came down and tested this level once, and it came really close to that a second time. Then Thursday is where things started to shift. We did gap lower, and we were below the 200-day simple moving average, but that ended up bringing in a lot of buying. We were able to get back above the 200-day simple moving average, go above the daily pivot for that day, and then close just off of the high. And then in Friday's session, we gapped higher and then continued going up into the close. So for the week, the Dow was up 1.7%, the Nasdaq was up 2.6%, the S&P up 1.9%, and the Russell 2000, which are small caps, was up 2%. Here are how the major indexes performed during the 5 days of February 27th through the March 3rd, with the Nasdaq and the Nasdaq 100 doing the best. The S&P, again, was up 1.59%, so all of the indexes ended up finishing higher on the week. Going back to year to date, we still have all of the indexes that are up. The Dow has now been able to climb back into positive territory where it had surrendered all of its gains. Well, it got some of those back in this past week. Going back to the all-time high, all of the indexes are still down overall, led by the Nasdaq 100 and the Nasdaq. Looking at our different sectors, the sector that performed the best were materials, followed by industrial, and then energy had a pretty good week. The sectors that didn't perform as well are the staples, as well as the utilities, and they ended up being down. This is a new chart that I haven't showed before. This is a type of market analysis that I've used for a long time, but it can be a little intimidating if you don't really know what this chart is saying. If you think back to your geometry class where you have an x-axis and a y-axis, well, right here is the middle, and anytime on the x-axis you go to the right, that's positive. Anytime you go to the left on the x-axis, that's negative. Then we have the y-axis. Whenever you go up, that's positive, and whenever you go down, that's negative. Those things that are performing the best would be at a plus for the x and a plus for the y, so these are the leading sectors. If we go over to the left, if they're improving, they have a positive y-axis, but a negative x-axis. Dropping down here on the right, if they're positive on their x-axis, but negative on the y-axis, they are weakening. And then the weakest, or lagging, are those that have a negative X and a negative Y. Over here on the right-hand side is a list of all the different sectors in the S&P. Just for example, if we take communication, which really suffered in 2022, well, it was starting to improve, and that's given this green line here. The head is where the circle is, so we had been improving, and now we're going over into the leading category. Another example would be staples. Here's a yellow line where it had been leading, but now it's starting to come back over into this weakening area, so it's moving down. Then looking at the utilities, which had been improving, but now are starting to show some weakness again as they go back into the lagging category. And what this tries to give us is a visual representation of what's moving stronger and what's moving weaker. This goes over the previous trading week to see how things are shifting around in the market. Sometimes if you're focused on a particular sector, you come to this chart and say, okay, I'm looking at industrials. Well, you find the industrial symbol right here, and it had been leading, but it's starting to show some weakness. Another thing to look at, how are the different sectors performing over the last week? Materials and energy did the best, followed by communication and then industrials, with tech also being positive. The only sector that was negative for the last 5 trading days were the staple sector, and utilities have been suffering. Discretionary is also bouncing up a little bit, but giving back some of its gains. Going back to the beginning of the year, we have communication, discretionary, and tech. These are areas that really suffered in 2022. They're showing some improvement in 2023, with staples, healthcare, and utilities being negative, and these are areas that did a lot better in 2022. Going back to the all-time high, energy is still way in first place, and then all the other sectors continue to be underwater since January of 2022. Looking at sentiment, we're starting to get back more to the neutral area as of Friday's close, and here's the historical chart where we really spiked up to 75, and then we're starting to come back down, although we did see a bit of a bounce in Friday with the upward movement. Here's the VIX, which continues to show that there's a lot of complacency in the market. We dropped below 20 and closed at that level on the line chart, and on the bar chart, we're pretty much just chopping sideways week after week. So there's just not an awful lot of fear right now in the market. The idea with the VIX is when it's low, it's time to go. When it's high, it's time to buy. Since it's very low, that means there's a lot of complacency and people are just waiting for this to spike back up, but it just isn't doing that. Looking at the active asset managers, they're starting to come back down. Now this survey is a week old where they had really topped out over 80 and since have been falling back down into more of a neutral stance. But at the same time, we are coming from a high reading down to a neutral reading, so that is slightly negative. The latest reading of the Ridex Bear Bull ratio shows that we're still at the midpoint. A lot of people aren't extremely fearful, nor are they extremely complacent. The latest survey for the American Association of Individual Investors shows that individual investors who are reacting to the difficult market that we had are starting to get extreme negative. So there's a lot of pessimism right now. When we get to these extreme readings, we tend to use this as a contrarian indicator. This could still go further, but since we had an up week, it likely bounced, and so we'll see a bit of an improvement in the next survey. The Ulcer Index is still below the moving average, showing that there's not an awful lot of fear. We're seeing the daily Ulcer Index start to go up, and it's above its moving average, but on a longer-term weekly chart, it's still suggesting there's not a lot of fear. Looking at some economic factors, this is the spread between the risky and not as risky loans. When this is really spiking up, that means that there's some real trouble in the economy. Well, we continue to go lower. And then looking at the Chicago Financial National Conditions Index, when we're above this black line, that signals that there's trouble. We're below the black line and declining. And then this hasn't been updated if you've watched the last couple of weekly videos. This is the tightening standards on banks, which also is a form of economic slowdown. When this is really going up, that means the banks are getting tighter with their lending standards. This chart hasn't been updated since the beginning of February. Looking at inflation, the latest reading of the Inflation Now cast shows that we pretty much have been going sideways, where CPI inflation and PCE inflation are a lot closer now than they were. Now we start to talk about the Fed. They have a meeting coming up on the 22nd of March, and right now there's a 71.6% chance that we'll be at 4.75% to 5%. That would be a 25 basis point move. There's still a lot of folks, 28.4% of the market, thinks that we might go with 50 basis points and be at 5 to 5.25%. The Fed continues to decrease its balance sheet as a lot of the instruments that it had purchased to really try to stimulate the economy, as those have been maturing and just fading away off of their balance sheet. Looking at breadth, we're still positive overall, where based on price and volume, we continue to be above this moving average, even though we saw a little bit of weakness this past week. The advance decline ratio continues to be above the zero line and advancing, so that's positive. New highs, new lows, a little bit of an expansion in the new highs, not really many new lows, but overall with our 4-week moving average, we are declining, and we're declining slightly with our 10-week moving average. Accumulation distribution is still positive overall. We're above an advancing moving average. Our trend shows that the ADX continues to be below 20 and is still declining. The green line is just barely on top. So we're currently in a trendless environment. And we're seeing that same thing on the daily chart. The Arun is a lot more negative on the daily chart. It's a little more positive here. This shows that buyers are still hanging in there with sellers decreasing. So when we look at the difference between the two, our oscillator on the bottom, we're above zero and advancing. We're on the daily chart, we're below zero and starting to go sideways. The mass index is not generating a signal currently. Looking at the daily chart, where we came right back down to this trend line, and this acted as support. This red line is also the 200-day moving average for the S&P. We came right down to that level, tested it a couple times, and have since been bouncing up. In Friday's session, we were able to close above this pivot, so that is more positive. But at the bottom, you can see where volume tends to be below average overall. We're still at the midpoint of our trend channel going back to 2009, and we're right at the monthly pivot. When we go above this pivot level and higher, that's more positive. At this pivot level and down, that's more negative. So we're currently at a tipping point right now. We regained the 50-period simple moving average, which equates to a 200-day moving average on the daily chart. So this is still remaining positive. In our long-term trend, we haven't seen a golden cross here. Where we have seen that on the daily chart, our weekly charts have not crossed yet. The bullish percent index on the daily chart is right around 50 and also on the weekly chart. So this is also suggesting that the market's right at an equilibrium right now, where it could go either way. The Chaikin oscillator is still above zero, and it did tick up this past week, so that's somewhat positive. The Chaikin money flow continues to be positive with advancing green bars. And the force index is also above zero and advancing, so that's positive. The McClellan oscillator was able to get back above zero and is advancing. That's positive. Our summation index based on price is still above zero, but it is declining. And volume, we are still below zero. So this is a mixed chart. Our look at the weekly oscillators shows that the slope is starting to turn down. The TSI is also rolling over a bit. Those are the short-term oscillators, where the intermediate term are the MACD, the PMO, and the PPO. They're still hanging in there, but they are rolling over, where our long-term oscillators, the TRIX and the KST, continue to advance. Swell trading oscillator based on price is just a little above zero, as well as volume. So this is looking more improved to the positive side. Our PMO study shows the PMOs continuing to rise, but we're slightly below this line based on price and volume. Our PMO study shows the percent of PMOs that are rising after getting extreme negative has been improving. We're still extreme negative with the buy signals, and we're seeing that on the daily chart as well. So this confirms each other. And also, we're seeing the same thing on the daily chart with the PMOs that are above zero continues to decline. The RSI going back 14 weeks is turning back more positive where it's above 50 and advancing. The special K continues to be above this red moving average, so that is positive. The Stochh RSI, after dropping below 0.5, has now been able to climb back above that, so that's turning more positive. And same thing with the Williams percent R, after showing some weakness, is starting to bounce back. The vortex shows that we're right at a midpoint right now, with the green line and the red line almost on top of each other, so that's neutral. The ultimate oscillator ticks sideways a little bit, but we're still above 50, so this is still positive. The money flow indicator was able to cross above 50 and is going higher, so that's positive. The Bollinger Bands were above the dashed line, so that is positive and showing a little advance. The rate of change going back 1 week since we had an up week, we are above the dashed line. Going back 50 weeks, we're still trying to show some improvement, but we're rolling over a bit here. The Kopik curve is not generating a signal currently, so it's now in a downtrend. We're still hanging out around the 10 and the 40 moving averages, but we were able to close above that, so that is positive. Looking at our different charts, the Heikin Ashi, we still have two black candles here, so that is negative. The Kegi remains black, and that is positive. The Renko has an open box, that's positive. The equivolume, going back 14 weeks, we are neutral. The point and figure chart didn't add any X's or O's this past week, and there's not a current signal that is being generated. The three-line break has open bars, that's positive. Looking at our Elder Impulse system for the S&P, we are neutral on the weekly chart where we've shifted back to positive on the daily chart. This is a little bit of a concern where the parabolic SAR, we have a dot on the top. Even though we had an up week, it's picking up some of the weakness that we've seen recently. On the daily charts, we just switched back over to being positive. So we're seeing some contradiction in our signals. Looking at the broad market, here's the S&P. The mid caps has still been performing about the best, followed by the small caps, and that can give some good support to the market. Looking at all stocks, after giving us a recent golden cross and some weakness, have been able to bounce back this past week. The mid caps also a recent golden cross and showing some renewed strength. Same thing with the small caps, some recent strength. The Dow, after coming down to its 200-day moving average, or here it's a 50-period moving average, was able to bounce up off of that. So support is holding for the Dow. The NASDAQ hasn't given us a golden cross yet, but it did have a good week. It was up 2.58%, so it's showing a little of improvement. And the NASDAQ 100 also testing its 200-day moving average and bouncing up off of that. The Wilshire has not given us a golden cross yet, but did show some improvement. The NYSE did give us a recent golden cross, and then some recent weakness has been bouncing back. FANG stocks hasn't given us a golden cross yet on the weekly chart. We're working off of a golden cross on the daily chart. ARK still has a long way to go to establish an uptrend, both on the daily and weekly charts. Looking at the biggest software companies, not getting a golden cross yet, but showing some improvement. Looking at traditional Dow theory, we're not really seeing anything too divergent right now, but we are seeing some weakness coming into utilities, where the Dow and the transports are more matching each other, even though transports are doing a little bit better. The Dow's pretty much been chopping sideways for about the last 6 months. After having a really good fall, it topped out and has been chopping sideways, where the transports are still showing a little bit more strength. But the utilities, after having a good end to 2022, have been falling back in 2023. Broad market. This is the CRB index, which we look at to get an inflation gauge. After giving us a recent death cross, have pretty much been chopping sideways. Copper. This is what we look at to try to determine what is the economy looking like going forward. When copper's going up, that means the economy is generally going to do better. When it's going down, that means it's worse. I have been seeing a few articles that are pointing to the idea that maybe copper going up too much could be inflationary. So the market's a little concerned about that right now. Gold, after giving us a golden cross, showed a lot of weakness, but we bounced back up 2.46% last week. And silver, also a recent golden cross, weakness, and hasn't really come back to its moving averages. Oil is right around the 80 level at 79.68. The dollar, after getting down here to the 102 to 101 level, had been bouncing, but this past week saw a little bit of a decline. Looking at bonds, the total bond ETF is not giving us a golden cross yet, so it had been showing some strength. It pulled back, but later in the week it saw some good upward price movement. Here's a daily chart of the yields after coming down. Now rates are having a tendency to go back up, but later in the week, this past week, they did decline. Here's the MOVE index, which is the VIX for bonds, shows how bonds have been going down, and so the volatility has been going up. Here's a weekly chart looking internationally with the US, UK, and German rates going back up. Japan still has pretty low rates overall, but they have their own separate scenario that they're dealing with. Looking at some relative studies, oil still is in the lead going back to the beginning of 2022, followed by the dollar, and gold has now been able to trip back positive, where the S&P and bonds continue to be negative but are showing some recent strength. The bond to S&P ratio still shows that bonds are underperforming stocks. It's also suggested in this chart, which is a monthly chart of the stock to bond ratio, showing how stocks are outperforming. Gold to the US dollar, after really starting to come back up, showed some weakness. Well, we bounced in this ratio in the past week. And gold to the S&P 500 is still in an overall uptrend. It saw some recent weakness, found some support at this moving average, and has been showing some improvement. Low volatility ratio to the S&P shows that the low volatility stocks are outperforming the S&P. Growth is continuing to underperform value. The NASDAQ 100 still is underperforming the S&P 500. It came right up to this red moving average, and that looks to be acting as resistance. Comparing the S&P 100 to the S&P 500 shows that the S&P 100 is underperforming. Discretionary continues to underperform staples. Energy continues to outperform tech. Looking at some other trend studies, both secular and cyclical, this is a signal that was generated back in October where we had an extreme negative reading, and you can see other times when that happened was at significant major lows. We've been bouncing up out of that, and if you look at what did the S&P do after that, it had a pretty strong upward move. We're not seeing that right now. That could be shifting at some point, where we saw a really strong beginning to 2023. February brought in some weakness. We'll have to see if things can turn and get more positive in March. Then also looking at some momentum studies. I was looking at a video this past week where they were pointing out the idea that it looks like we broke that downward sloping trend line just enough to fake things out, and now we're trying to determine, are we going to continue higher from that, or are we going to get faked out and end up going lower? So I went back to 1998 to 2004. That's what you see right here. The first trend that we're looking at, where we were going down from late 2000 into 2001, it looked like right here we had been able to break this downward sloping trend line. So what do? We look down at the bottom at the MACD. What was the MACD doing? This still suggests that momentum, although improving, was still way below zero. So the market ended up getting faked out and then going even lower. Getting into 2001, into 2002, we saw the same thing. There was a downward sloping trend line. It looked like we were breaking out right here, but look down here at the bottom as to what the MACD was doing. It was improving, but it was still below zero. So the market ended up getting faked out again before ultimately hitting its low. Then we shift over to the 2007 to 2010 period. Also, downward sloping trend line. Looked like we were breaking out, but what was the MACD doing? It was going flat. So right after that, the market ended up exhibiting a lot of weakness. Now we look at 2017 to the present, where we are starting to break above this trend line, but look at what the MACD is doing. It is rolling over a bit, so it doesn't mean that this is, hey, here we go, we're going to the moon, but we're seeing more strength in the MACD than what we were seeing the other time. So we want to keep an eye on this. Even though this is a weekly chart, I'm going to be looking at this every day to see how this momentum is holding up or breaking down. But right now, this is looking more positive overall as we're starting to break above this downward sloping trend line. What's our outlook for the upcoming week? On Monday, we have factory orders coming out. On Tuesday, wholesale inventories with consumer credit. Wednesday, we have our weekly mortgage applications index, the 80 employment change, as well as the JOLTS job openings, trade balance, and then near the end of the day is the Fed's beige book. On Thursday, we have the usual jobless claims, and then on Friday is going to be the big employment situation report. Looking back to last month, this is where the market freaked out. We had a much stronger than expected report, and it sent waves through the market, and that's when we started to hit these real headwinds that the market's been dealing with. So a lot of people are really anticipating this report coming out. We also will be getting the Treasury budget. So as far as our technicals, you can see we're showing some improvement overall. We're still positive. There are some things to be concerned about, but we're not really trending right now as the market deals with this inflation and interest rate scenario. There will be some speeches coming up this week. The big one will be on Tuesday and Wednesday, where Chairperson Powell will testify before Congress. On Tuesday, he'll talk before the Senate committee. And then on Wednesday, he'll go before the House. His prepared remarks, the market will really react to those on Tuesday because they haven't heard those before, but it'll pretty much read the same comments in Wednesday's session. It'll be the question and answer period where the markets will really be paying attention to that and then gyrating around depending on what he says. Then on Thursday, Vice Chair Barr will be giving a speech on crypto. Looking at the Stock Traders Almanac statistics for Monday, I'm just going down to the day. You can pause this and look at all these different statistics that we have here. But in Monday's session, we're more or less neutral. The Dow is only up 47.6% of the time, so that's neutral to negative, where the S&P is a little bit over 50%, so we're neutral to positive. The Nasdaq's a little bit weaker at 42.9%. And then looking at the month of March, it has a tendency to be up 64.4% of the time and down 35.6% of the time. And then we're still working off of the 3-0 trifecta with the Santa Claus rally, the first 5 trading days of 2023, and then January was up. So that's giving us a score of 3-0. And the market still likes that we're split between Democrat and Republican within the government. Looking at the trading day for Monday, that's the 4th trading day of the month. Historically, the green line, which is the S&P, that would show some weakness. But in a pre-election year, which is where we're at right now, we look at this dashed green line, and it has a tendency to be somewhat positive historically before topping out in trading day 5 and then showing some sideways action. Also, we're following the green line on this chart because we're in a pre-election after a midterm bear. So this tends to historically point to the fact that the market has some longer-term support. And then we're also coming into that sweet spot for the S&P 500, which is right inside this red box. Another thing that I found from Earnings Beats, this is from their email. This is looking at the month of March, where they say it tends to be a slightly bullish month. Looking at the performance, where we've had a good start to the month, giving us a return of 39.41%, but then going into the next week, the 6th through the 9th, we're down over 20%. Then in the 3rd week, we go back to being positive, and then we finish out the month being flat to negative. The sector that is really hot would be the utilities, and the sector that really has a lot of weakness would be the financials. Looking at our scenarios for Monday's session, can't go with either up or down right now because we're not trending overall. The technicals are still negative on the daily charts, but starting to turn positive, especially in the short term. And it's hard to really go with the up scenario currently because everything is still pointing down overall. So we're going with the sideways scenario because the ADX is weakening. It's below 20, but we did see the green line cross back over the red line, so it is positive. Thank you. I hope you found this helpful. Please feel free to check out the daily videos that I post. I'll also be preparing an intermarket analysis video, another video that I call the deep dive video where I talk about the charts that I really don't cover in this past week's videos. And I'll also be preparing a supplemental video where I go through the current market valuation website as well as charts that we find at isabelnet.com. Have a great weekend, and I'll talk to you in the next video.